This is Saturday, January 31st, 2026, the last day of January. And if you checked precious metals prices yesterday, you witnessed absolute carnage. Silver crashed from $33.85 to $29.67, over $4.18 gone in a single day. That's a brutal 12.3% crash, one of the worst single-day drops in years. Gold plummeted from $2,156 to $28.1, a $55 nosedive that sent shockwaves through the entire precious metals market. If you're watching this and you're panicking right now, I need you to stop, take a breath, and watch this entire video, because what I'm about to show you doesn't make any sense. Welcome to the Financial Forensics. I'm here to expose what's really happening in markets while everyone else is distracted by headlines. Subscribe right now because this analysis cuts through the noise, and if you find value here, smash that like button. It helps more people see what the mainstream won't tell you. Let me be very clear about what just happened. Silver crashed 12.3% on Friday. The last trading day of January 2026, one of the most violent single-day drops we've seen since the 2020 pandemic crash. And yet, right now, at this very moment, try buying physical silver at spot price. Go ahead. Try it. You can't. Major dealers like APMEX, JM Bullion, and SD Bullion are showing premiums of $5.50 to $8 over spot on basic silver rounds. That's 27% premiums. American Silver Eagles, you're looking at $10, $13 premiums. On a $29.67 spot price, you're actually paying $39.40 Tau. Let me say that again so it sinks in. The price crashed 12% yesterday, but you're still paying 42% over spot to actually buy physical. Does that make sense to you? Does that sound like a normal functioning market? In any legitimate market, when price crashes, supply floods in, sellers panic and dump inventory, product becomes abundant, premiums collapse. That's economics 101, but that's not what's happening here. The paper price is in free fall while physical premiums remain sky high. The price dropped 12%, but you still can't buy silver anywhere near the crashed price. Something is fundamentally broken. Most people don't understand this, and that misunderstanding is costing them a fortune. There are two silver markets, not one, two completely different worlds. The paper market. This is COMEX. This is where futures contracts and derivatives trade, where hedge funds and banks trade billions of dollars of silver every single day. But here's what you need to understand. They're not trading real silver. They're trading paper promises, digital contracts that say someone will deliver silver at some point in the future. Most of these contracts never result in actual delivery. They're just bets, casino chips, financial instruments with no physical metal backing them. The leverage in this market is insane. For every ounce of real silver, there are estimates of 100 to 250 paper ounces trading on COMEX. The physical market, this is where actual silver trades, real metal, coins you can hold, bars you can stack, the stuff that actually exists in vaults and safes. Now here's the critical point. These two markets are supposed to be connected. The paper price is supposed to reflect what physical silver is actually worth in the real world, but right now, at the end of January 2026, they're completely disconnected. The paper market says silver is $29.67. The physical market says you're paying $39.42 to actually get it in your hands. That's a 42% spread. One of these prices is lying to you. Which one do you believe? The computer screen flashing red numbers or the actual checkout price when you try to buy? The Friday massacre. Timing is everything. Let me talk about timing because Friday's crash was not random. This was calculated. January 31st, 2026, the last trading day of the month. The end of the most volatile January precious metals have seen in nearly a decade. This is not coincidence. Big institutional moves always happen on end-of-month Fridays. Options expire, futures contracts settle, hedge funds rebalance, banks close their monthly books. Silver started January around $30, $50. It rallied to $33.85 by mid-month, an impressive 11% gain in just 2 weeks. Momentum was building. Retail investors were getting excited. FOMO was kicking in. Then, on the very last trading day of January, on a Friday when liquidity is thin, they crashed it hard and fast, from $33.85 to $29.67 in a single session. They crushed the bulls. They shook out weak hands, they triggered stop losses, and they created maximum fear. This is how the game is played. This is how wealth is transferred from emotional retail traders to patient institutional accumulators. Your fear becomes their buying opportunity. Your panic becomes their profit. Let me show you what's really happening behind the curtain. The U.S. Mint just released preliminary numbers. January 2026, Silver Eagle sales totaled 2.1 million ounces. That's a 47% increase compared to January 2025. Read that again. During a month that ended with a 12% crash, the U.S. Mint sold nearly 50% more silver than they did last January. Physical demand is absolutely surging. Perth Mint in Australia reported in their latest update that silver product demand remains exceptionally strong, with particular buying pressure from Asian markets. India's silver imports for January 2026 are estimated at over 320 metric tons. That's the highest January import figure in over 5 years. So let me ask you this. If physical demand is up 47% at the US Mint, if Perth Mint reports exceptional demand, if India is importing record amounts, why is the paper price crashing? Here's where it gets really interesting, and this is critical to understand. Friday's selling happened almost entirely during US market hours, not during Asian trading when Shanghai, Tokyo, and Hong Kong are active, not during European hours when London opens, not US market hours, COMEX hours, New York hours. When COMEX opened Friday morning, massive sell orders started flooding the market. Wave after wave of aggressive selling that drove the price down relentlessly. This wasn't retail investors panic selling their coin collections. This was institutional selling of enormous paper positions. Hundreds of millions of paper ounces dumped on the market in what looked like a coordinated liquidation. Meanwhile, what's happening in the physical market around the world? Asian buyers are stepping in at these lower prices. Middle Eastern sovereign wealth funds are quietly accumulating. Smart money is taking delivery of actual metal. The pattern is clear. The US sells paper, digital contracts, derivatives, promises, IOUs. The rest of the world buys physical, actual metal loaded into trucks, shipped to vaults, locked away. One side is playing a video game with unlimited lives. The other side is taking home the actual prize. What happened Friday didn't start Friday. This has been building for years, and it's accelerating. According to the Silver Institute's latest World Silver Survey, silver has been in a supply deficit for 4 consecutive years. 2022, 237 million ounce deficit. 2023, 184 million ounce deficit. 2024, 215 million ounce deficit. 2025, estimated 198 million ounce deficit. That means for 4 straight years, global demand has exceeded mine supply by a combined 834 million ounces. That's nearly 1 billion ounces of deficit in just 4 years. Where does that extra silver come from when mines can't produce enough? It comes from above-ground stockpiles, from exchange vaults, from reserves built up over previous decades. Think of it like a savings account. Mine supply is your monthly paycheck. Demand is your spending. For 4 years, you've been spending more than you earn. You've been draining your savings account to make up the difference. But savings accounts eventually run dry. And here's the scary part. COMEX registered silver, the silver available for immediate physical delivery, has been steadily collapsing. In early 2021, COMEX held over 150 million ounces of registered silver. As of this week, January 2026, under 68 million ounces. That's a 55% decline in just 5 years. The cushion is gone. The buffer has been depleted. The emergency reserves are critically low. And Friday's crash? It just created a massive new wave of buyers looking to scoop up physical at these discount prices, which means the shortage is about to accelerate dramatically. If you're holding physical silver, do not panic, do not sell, do not let yesterday's paper price manipulation scare you into giving up your metal. Look at the actual facts on the ground. US Mint sales up 47% in January 2026. Physical premiums still 18-27% on rounds, 34-44% on eagles. COMEX registered inventory down 55% since 2021. Asian and Middle Eastern buyers aggressively accumulating 4 straight years of supply deficits. The paper price is theater. It's manipulation. It's smoke and mirrors. Your physical metal is worth what someone will actually pay for it in the real world. Right now, that's $35 to $40 per ounce, not $29.67. Hold your metal. Do not be shaken out at the bottom. If you're holding paper silver, ETFs like SLV, futures contracts, you need to ask yourself this critical question. If everyone holding paper silver demanded physical delivery on Monday morning, could your counterparty actually deliver the metal? The answer is absolutely not. There isn't enough registered silver in existence. You don't own silver, you own a promise, a digital entry in a database, and promises break when stress tests arrive. If you're looking to buy right now, understand this paradox. The lower the paper price crashes, the faster physical silver disappears from the market. Lower prices don't create more supply. They create explosive demand, more buyers, faster vault drainage, higher premiums. Friday's crash is making the physical shortage worse, not better. This exact pattern has played out before, and history is screaming at us. March 2020, during the COVID crash, silver dropped from $18 to $11.60 in a matter of days. Physical premiums instantly exploded to $7 to $9 per ounce. Silver Eagles were completely sold out everywhere. Major dealers had 6 to 8-week delivery delays. Some stopped taking orders entirely. The paper price said $12. The real world price was $19.21. What happened next? By August 2020, Just 5 months later, silver hit $29.35. The paper price eventually caught up to physical reality. It always does. It has to. Friday's crash is following the exact same playbook. 1. Paper dumps violently. 2. Physical disappears from the market. 3. Premiums stay elevated or rise. 4. Eventually, paper price adjusts upward to reflect physical scarcity. The paper market can manipulate prices in the short term. They can create crashes. They can generate fear. But they cannot create physical silver out of thin air. They cannot mine it with a keystroke. They cannot print it like currency. They cannot conjure metal that doesn't exist. Paper manipulation can delay the inevitable price adjustment. It cannot prevent it forever. Physics and geology always win in the end. Yesterday, January 30th, 2026, silver crashed 12.3% in a single brutal session. On that exact same day, U.S. Mint reported 47% higher. January sales versus 2025. Physical premiums remained at 32.44% over a crashed spot price. COMEX registered silver sits at 5-year lows of 68 million ounces. Asian and Middle Eastern physical buyers stepped in aggressively. We're in year 5 of consecutive supply deficits. The paper price crashed. The physical metal is vanishing. One of these signals is real. The other is manipulation. And it's not the empty vaults that are lying. This is what a broken market looks like. This is the final stage disconnect between paper promises and physical reality. This is what happens when a system built on leverage, derivatives, and digital contracts finally confronts the immutable laws of supply and demand. They can dump paper silver on the last day of January, but they cannot create the physical metal that the world is demanding. Smart money around the world is using this crash to accumulate real metal at artificial discounts. You get to decide which side of that trade you want to be on. Drop a comment and tell me, did you buy this dip, hold through it, or panic sell? I read every single comment, and I want to know where you stand. Subscribe if you haven't already. Hit that notification bell because February 2026 is setting up to be absolutely wild. This is the Financial Forensics. The truth is never in the headlines. I'll see you in the next one.